Hi, I'm Josh Kettleson.
And I'm Christo Schultz.
Christo, people talk about risk. They talk about losing all their money. It's one extreme or the other. Either I make money or I go to zero.
Yeah.
In a diversified portfolio, there's very little chance of your portfolio going to zero.
To
Can we agree that?
Mm-hmm.
I mean, the chance of it going down 20, 30, 40, 50%, depending on how it's allocated, is likely.
Yeah.
And we'll tell you it's likely, and we'll try to model your plan after it. But besides market risk, meaning the things go up and down, what other kinds of risk are there? One that comes to mind in particular, inflationary risk. Can you talk a little bit about inflationary risk?
Yeah, it's the risk that the cost of goods that we are so accustomed to buying, like gasoline, milk, your electricity, all those things that we need to live on will increase, the price will increase. They won't increase in value, but the price will increase that it costs us to pay. And so how do you combat that? And what assets you want to own in order to diversify, make sure that if there is inflationary risk, you're okay.
Inflationary risk in terms of your investments not keeping up with the cost of inflation. So if you have a risk-free investment vehicle right now, it's paying less than zero. Because less than zero on an after-tax, after inflation rate, adjusted rate of return. So your risk-free investment might be risk-free from a default perspective.
Yeah, and you got to think about it. You're actually losing money.
Yeah.
Let's say you have an investment that guarantees a 1% return, which in today seems like a decent little investment. But if inflation is going up by 3%, you're losing 2% on that investment. No one wants to do that. And that's something that a lot of people don't consider when they're thinking about
unless it's an IRA, you're going to be taxed on that 1% growth that you had to begin with.
That you're losing money on.
You're losing even more. So the real return after tax, after inflation, rate of return on risk-free investments is always zero or less. Is that pretty accurate to say?
It's pretty accurate. Yeah. Today it is.
Yeah, it's accurate to say. There's always going to be reasons not to think that, but generally speaking, if there's not that risk.
Another risk that I think is very common that we talk about every 4 years at least is political risk.
Political risk, big time, yeah. Another word for that is legislative risk, right? Which mentality is currently representing us in Congress or in the White House, right?
Yep.
And we've seen a lot of that, haven't we?
Yeah. No, there's always risk of what's coming down the pipeline from a law perspective. I think geopolitical risk is another one. What are these other countries around the world doing, and how's it going to affect me, my portfolio, the company I work for? There's a plethora of different things. But what are your thoughts on reinvestment rate risk?
It's a huge risk, actually, Christo, because I've lived through it. We had clients in high-grade corporate bonds paying 7% at one time, and things were good. On a $200,000 investment, they were making $14,000 a year, which is about 50% of what they were making on Social Security. Life is good, right? Those bonds come mature, or they get called early, meaning the issuer decides to pay them off early. Now you might have to take that money and invest it at 3%. So what was $14,000 a year is now $6,000 a year.
Right.
What family, including ours, wouldn't feel a $7,000 or $8,000 dip in income? And that's just one example of one security. And it's going to be the same thing if you have bonds or a bond fund. There's a chance that the high rate of return you're receiving now, on a presumably pretty safe basis, won't be there 1 or 2 years down the line.
I mean, we saw during COVID there were several companies that cut their dividends, and for an older retiree, that can be substantial if your dividend gets cut from 3% down to 2%, 1%.
Sure, absolutely.